Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I'd like to share what is probably a controversial view and a controversial topic to some degree in the financial planning space. You know, there's a high probability that your super is invested across various asset classes, mainly or more specifically, bonds and fixed interest defensive style investments. And then also the share market. Now, nearly all investment professionals would argue that shares have the greatest probability of delivering the highest return over the long term. So that's what I'd like to discuss today. The question is, why wouldn't you invest 100% of your super in the share market and forget about all the other asset classes? So before we get into that, let's talk about how your super is probably invested. Now, this is especially true if you're with an industry super fund, which most Australians are. Now, it might be different if you're not, right? So if you've got your own self-managed super or if you're on a wrap platform, it could be different. But for those that are in industry super funds, there tends to be two kind of investment options. There's a pre-mixed investment option, things like high growth, balanced, diversified. And whilst these can be a little bit misleading because what one fund might call a growth fund or growth option, I should say, another super fund will call that balanced. So you can't really rely on the name to determine or tell you, what the asset allocation is of that particular option, because there is no sort of set formula, I guess, that they all have to follow. Now, the difference between all is really the amount of growth assets or the amount that's allocated into the share market. So in a diversified or conservative fund, maybe it's a lower amount, maybe 50%. In a high growth option, about 80 or 90% of your total balance will be invested in the share market. And then, of course, there's a whole bunch of other assets, unlisted assets, private equity, etc., etc. But really, let's just focus on the shares because that's really the growth portion and that's the bit that we really want to talk about. Another option that's really growing in popularity is what's called a lifecycle investment strategy. So instead of you picking, I want high growth or growth, you just pick your year of birth. So it's really based on kind of age. And what the fund does is work out, well, okay, for someone that's born in 1970, they're getting pretty close to accessing their super, so pretty close to reaching the age of 60, so we'll have a little bit more of a conservative asset allocation. However, someone that's born in 2000s, they're miles away from accessing super, so we can have a more aggressive asset allocation, so a higher proportion goes into growth assets, so the share market, maybe it's about 90% or something like that. The benefit of a life cycle investment strategy is you don't need to think about it. In fact, you could just nominate your life cycle investment strategy and never look at the asset allocation until you're retired, because it will naturally or automatically just change as you get older. Now, the question we should ask ourselves, who comes up with this asset allocation? Who decided that, part of your money should go into bonds or fixed interest or defensive investments, safer investments, and the other part should go into more growth asset allocation? Well, it really started in the 50s when Harry Markowitz developed what he called modern portfolio theory. And the thesis behind it was that, you should invest in a variety of asset classes, I should say, really to reduce the portfolio's risk and volatility. So there's really sort of 2 points, or you can summarize that in 2 points. The first one is diversification, or diversifying across different asset classes allows you to smooth out returns because hopefully you're investing in asset classes that are negatively correlated with shares, so they move in an opposite direction to what shares move in, or they're uncorrelated, so they move independently, which means that the theory is that if you invest in shares and the share market has a terrible year, it's likely bonds will have a positive years because they're normally negatively correlated, and the reverse is true. So there's going to be asset classes that win from year to year and asset classes that lose from year to year. So if you're spreading your eggs across multiple baskets, hopefully at a total portfolio level, you get to sort of smooth those investment returns. The second sort of observation would be that, of course, all asset classes move in cycles, and it can be that, for example, the share market becomes overvalued or goes through a substantial growth cycle, and we know that if we have a period of above average returns, which is typically followed by a period of below average returns, that sort of mean reversion that I keep talking about in this podcast. And so therefore, by diversifying across various asset classes, again, you get to kind of smooth that out, because there's going to be asset classes that are undervalued, and by rebalancing every 6 to 12 months, you're sort of forced to take take money from the winners and put it in the losers, knowing that those losers will eventually turn around. And they're there's lots of reasons around modern portfolio theory and having a diversified asset allocation, but they're kind of the two main reasons that is sort of the foundation of modern portfolio theory. And I don't disagree with that at all. However, we've got to recognize that super in Australia is very different because you really can't access it until you're 60 and retired, or 65, irrespective of if you're working or not. And so we are forced then to be long-term investors, because really smoothing returns and reducing volatility is only important if you need to interrupt your strategy, if you need to sell those investments before you expect or need to do so, where you can't really do that inside super because you can't access it. And that's why volatility really isn't that important. I mean, if you look at your super balance every day and you lose sleep over it, well, then volatility to you is important. But from a practical perspective, volatility is not important. Who cares what the balance does over the next 20 years? Just so long as in 20 years' time, there's a huge probability that you're going to be miles in front. If you can achieve the highest return over the next 20 or 30 years, that's the most important thing. Whether it's a roller coaster ride or not is neither here nor there, really. So, for example, if you can swing for the fences and achieve a 9% compounding return over the long run, over the next 2 decades, your balance will be worth more than 5 times what it is today. You know, that we can't ignore the fact that a relatively small increase in returns, maybe an extra percent over a very long period of time, has a tremendous impact on our super balance. And so I share a chart in the blog on the website which charts the last 30 years of returns, and it really clearly shows that the share market compared to bonds and cash outperforms significantly. So US and Australian shares, more than 10%, bonds around 5.5% to 6% over the last 30 years. And the thing is, we need to remind ourselves that predicting short-term returns, what will the share market do over the next couple of years? Inherently difficult. It's like predicting the weather. It's just, you just probably don't have, if you're right, it's probably just luck. Whereas predicting returns over very long periods of time is far easier because you get to smooth out, the volatility over that period of time. So I think if you went all shares, you could reasonably expect that your returns over very long periods of time are going to be north of 9% compounding. Again, if you can get 9% compounding in your super, that's going to really do you a big favor. So then let's return to the question, should you invest all your super in shares? Well, of course, if we're just looking at returns alone, the answer is yes. But of course, there's a couple of caveats here. So firstly, it depends on how you're investing in shares. So, to use the current situation as example, at the moment, the concentration risk in the US share market and the US index is a real concern. The top 10 companies in the S&P 500 account for more than 1/3 of the total index in terms of value, and 7 of the top 10 companies are in technology. So you have a huge concentration in 10 companies and a huge concentration, therefore, in the tech sector, which you might argue is, advantageous. And of course it is. I'm sure technology will be a huge driver over the next couple of decades. The question is, to what extent is that already reflected or over-reflected in current prices? In fact, Nvidia, Microsoft and Apple, just those 3 companies, account for a record 21% of the index. So really, by investing in the S&P 500 index, you're almost a direct share investor because a lot of your money is just in, 3 stocks or 3 names. So I think, therefore, if you're considering putting 100% of your super in shares, then it's really crucial that you use several rules-based low-cost index strategies to mitigate some of the risks and opportunities, or maximize opportunities that are currently in the share market. So relying solely on cap-weighted index, comes with risk because you'll have that concentration risk. Whereas if you can use different index strategies that accommodate the risks and opportunities in different geographical markets, then you can reduce the portfolio's risk to a great extent, in my opinion. So that's the first caveat. How are you investing your super? The second consideration, if you're a nervous investor, that checks their super balance frequently and worries about the fluctuations and maybe loses sleep at night, then putting all your super in shares probably isn't the right approach for you. The reality is that you've got to expect significant fluctuations fluctuations. So every 5 to 10 years, you're probably going to experience a correction, which means that the value of your balance will drop 20 or 30%. Now, the market tends to recover very quickly from corrections, almost always within 2 years, but often within 12 months. So it's not going to have a big impact longer term, or it's not actually going to have any impact longer term. But if you log in and see your balance and it's substantially lower and you're going to really worry about that, then it's not for you, as I said. And finally, if you might access your super within the next decade, so 10 or less years, then it might not be appropriate to put it all into shares. Now, of course, this depends on your individual situation, your risk profile. Do you have other investment assets in addition to shares, and therefore can you stomach the volatility? So I'm not saying definitely reduce your asset allocation and make it a little bit more conservative as you approach retirement, but that's something that you want to start thinking about, and it depends on, as I said, your personal circumstances. Now, of course, none of the information in any of these podcasts is ever personal advice. I just don't know your personal circumstances, of course, and there's a number of factors to consider when making those sorts of decisions. So I'm not saying they're the three considerations and there's no other considerations. There could be lots of other considerations that are specific to your personal circumstances, of course. Now, if you have a look at that chart on the website that charts the last 30 years of investment returns, you'll note that international listed property and Australian listed property, which is referred to as REITs or REIT, real estate investment trusts, which are really just listed companies that generate most of their income and profit from renting property, essentially. I mean, that's a very high-level definition of what REITs are, but, it is what it is. And these asset classes have done really well over the last 30 years. So international's delivered 9.7%, Australian listed property 9%. And so anyone looking at that chart might think, well, should I put money in REITs as well? REITs tend to be quite cyclical. They're really dependent on things like interest rates, inflation, overall economic health. So they can be quite cyclical. And also, a lot of these REITs are already included in the general equity indexes as well. So I'm not talking people out of having some exposure to listed property, but I just don't think it's necessary. And in the context of this discussion's really about, do we go all growth assets or do we have a traditional asset allocation, that 99% of Australians have inside their super? That's what I'm sort of talking about today. How you go about implementing that full growth asset allocation is really going to depend, as I said, on your individual situation. Now, a common question, which I've sort of touched on already a little bit, is when do we start reducing or changing our asset allocation? And the theory is that as you get closer to needing your investment balance, and particularly as you get into retirement, that's when you should de-risk your portfolio, because arguably at that time, you can't stomach high volatility. If someone enters retirement and they're solely relying on super, that's the sole source of funds to fund retirement, they can't stomach waking up one day and their balance is 30% lower. I mean, that's just not appropriate for their circumstances. So it's going to depend on your individual circumstances, but as you start approaching retirement, certainly as you get into retirement, it might be appropriate to sort of back it off a little bit in terms of growth profile. At some point, capital preservation becomes more important than investment returns. Once you have more than enough money to fund retirement, I would argue then keeping that money is more important than making more money off that money. And so some of my clients, for example, might have 40 or 50% of their portfolio invested in growth assets, so it's quite conservative. And others, also in retirement, might still have 80 or more percent invested in growth assets. As I said, depends on individual circumstances. Now, I did receive a really interesting question from Matthew on YouTube, and he asked me about whether young people should use geared ETFs, exchange traded funds, to invest their super in. So not only just going, okay, should we go 100% growth, but what about adding some borrowings into that as well? And to answer Matthew's questions, I use the same principles that I've talked about in this blog. And the principles are, obviously, shares are going to deliver the highest return over the next 20 or 30 years. That's not controversial to say that. If we then add gearing into that, we're going to further enhance those returns, because obviously you're increasing the amount that you're exposed to in the share market, and you're probably going to increase or magnify those returns by another 2 or 3% per annum. And we know a substantial increase in the compounding capital growth rate will have a huge impact on the balance. So theoretically, the answer is yes. If you're young, say in your 20s or 30s, why not include some gearing inside super? However, I think it's going to be difficult to do and maybe not always appropriate either. So the first concern is that how do you do it? So a lot of wrap platforms will have limits on the amount that you can invest in any one particular ETF. So it's not like you can say, okay, I'll go onto a wrap platform and go and buy an ETF with the code GHHF, which is a beta shares ETF that gives you a diversified asset allocation with some gearing in it. You can't do that. You can't put 100% of your super in there because the trustee won't allow you to do it because it wants you to have some diversification. So if you wanted to do that, the only way to do that is to establish your own self-managed super fund and then put all your money into GHHF, and that could work. But of course, establishing a self-managed super fund, you need to be careful, you need to get advice. It's costly, it takes time to look after all the compliance elements as well, and so on and so forth. The second concern is that internally geared ETFs tend to only use market cap weighted indexes. And I've spoken about my concerns, for example, referencing the current situation in the US in terms of concentration risk and the impact of that. So that's something else that you'd really need to consider. So I think theoretically, yes, gearing inside super is probably going to be attractive, particularly if you're, as I said, in your 20s and 30s. But the challenge is really implementing it effectively in this market, given the current product suite that we have to play with in Australia, which is changing very rapidly, by the way. So just to sum up, I mean, investing 100% of your super into the share market really does challenge conventional wisdom or the traditional way of thinking about how we invest in super. And I doubt many financial advice firms would actually be recommending it to their clients, maybe because they're concerned about their own risk, making sure that, if you make sure that people understand what they're doing and it's appropriate, I would argue that there's not as much risk there, but I don't think it's a common thing. But it's part of our job, I think, to challenge that conventional wisdom, to continue to ask ourselves, is this the right approach given our environment in terms of super in Australia? But of course, one of a financial advisor's primary goals is to maximize wealth for clients, to maximize wealth, to enjoy a comfortable retirement. And so part of that, I think we should be asking ourselves the question about asset allocation and, as I said, challenging that conventional wisdom. It's not going to be for everyone. There's going to be a whole lot of individuals that it's not appropriate for some of the reasons that I've spoke about, including risk profile. And of course, a reminder, before you go and change your super, please get advice. A lot of industry super funds now do offer financial advice to members. And so that's something that you can talk to them about. And before I leave you, if you do have any questions, the best way to do that or provide your questions is on YouTube. One of the downsides to podcasting is it's a one-way conversation. We don't get to have a two-way conversation, but the first link in the show notes is a link to a video where you can post a question if you've got a question to me, and I'll try and answer it on YouTube for you. Okay, until next week, bye for now.